So let's talk about also what the Wall Street takeaway is. Consumers generally don't like to see higher prices. What effect does that have on spending, et cetera? Whether Coca-Cola can bottle up Wall Street enthusiasm. Gerald Pascarelli, Wedbush Securities SVP of Equity Research, is here with us now. Gerald, what's your take on the company's numbers? I have to admit, I was surprised with higher prices, still saw an increase in those case volumes.
Sure. Well, thanks very much for having me. I think when you look at the start to the year, it was a very good print for Coke. I look at this largely as a continuation of what we really saw over the vast majority of 2022, where outsized price mix is driving above algorithm revenue growth for Coke, for peers. Non-alcoholic beverages is just a category that has been very strong. And this outsized pricing is really helping to offset outsized levels of commodity inflation. I think you're seeing that flow through to not only top line beats but also earnings beats. And so Coke as a bellwether for kind of what to expect for this earnings season, we thought it was very encouraging.
Is there a top fizzy drinks pick from the Wedbush or the broader kind of analyst viewpoint right now when you think about the consumer environment, where consumers are still willing to take price, and the product mix that a Coke might have versus a Pepsi or even a Nestle more broadly here across the landscape?
Sure. So in soda, we're actually recommending all three companies. We're recommending Coke, we're recommending Pepsi, as well as Dr. Pepper. We also recommend a company called Celsius Holdings. They're smaller, kind of a disruptive energy drinks company. That's our top pick in the space, but we think that from what we've seen in terms of consumer resiliency and continued earnings beats for most of these companies, we remain constructive on the broad space. We think these are grind higher stocks, and we think today's earnings results for Coke certainly speak to that.
And so when we look at these Coke results and when we look at, as you said, the read through to the rest of the industry, I'm also curious about what's happening on the cost front, right? Because we see these prices continue to go higher for consumers. Is Coke feeling that same pressure in its input costs?
So it was for sure back in 2022. And I think that when you look at where these companies are guiding, all top line guidance essentially is implying a deceleration relative to what these companies did in 2022. And so embedded in that assumption for decelerating revenue growth is that you're going to see moderating levels of pricing as we progress throughout the year. And that's going to come in tandem with a better cost outlook, certainly relative to what we saw last year. So you're going to have pricing coming down. At the same time, you're going to have many commodity input costs that are moderating. And so that is ultimately what is going to protect bottom line profitability. Double-digit pricing is largely unsustainable over the long term. And so when you look at the cadence of kind of what to expect for Coke and then what to expect for their peers, the 11 points of price mix that they delivered in 1Q was largely carryover pricing from pricing actions taken in the fourth quarter. That likely flows through to 2Q, and then you probably see it start to moderate in the back half of the year.
And Joe, I've heard the term excuseflation bandied about a little bit in this current cycle, right? That like the companies, they're going to take as much price as they can, even if their costs are not going up at the same rate. Is that starting to happen within the beverage industry in particular? And at what point do consumers say, wait a minute, and start to push back on that?
So I think the broad outlook is companies will always take as much pricing as they can.
Sure.
As kind of an intra-quarter read that we use and that many sell-side analysts use, we rely on Nielsen or IRI data. And what we've started to see in carbonated soft drinks, which is obviously Coke's most important category, pricing remains very strong, but volumes, the volume declines have actually become more pronounced. If volumes were kind of flattish to down low single digits, over the past couple of months now they're down mid-single digits. And so you may be seeing early signs of just a prolonged impact to the consumer's ability to absorb these price increases. And so that's something that we're certainly going to continue to monitor over the next 3 months as we really try to get a read on what to expect going into the second quarter. So I think there's going to be more to come on that. But when you're talking about staples and you're certainly talking about soda or salty snacks, these are very much need-based categories that are on the broad spectrum of things, lower priced relative to other categories, right? So I think that gives these companies some more protection to be able to price through some of this outsized commodity inflation.
Do you think that we're going to see any additional consolidation, kind of beefing up of the catalog of products that these companies hold on to right now? I mean, even when we were parsing through Coca-Cola's results, it's a reminder of how much acquisition's been necessary in the coffee business, in the sports drink business, and even into the soft drink business as well, in tandem with what had already been their kind of patented ingredient for decades, right? And so all of that considered, do you think we're going to see a little bit more of an M&A type of landscape for some of the beverage companies?
I think that there's always the potential for bolt-on M&A to enhance your overall portfolio in areas you may under-index to. When you look at current categories that to us look interesting, sports drinks looks like it's a category that's kind of being disrupted by some smaller competitors. I know Coke had the Body Armor acquisition, which they're kind of continuing to incorporate into their portfolio, but I don't know that it's going to be M&A on a large scale. I think it's going to be ways to just enhance a portfolio by looking at where you either over-index or under-index relative to peers and trying to figure out what the most optimal mix to drive the most sustainable revenue growth will be.
There's a specific drink I want to ask you about, Gerald, and that is Starry, which is the new Pepsi drink that replaces Sierra Mist, sort of has a retro-looking can. How's that going to do for them, do you think?
So if you look at Sierra Mist, it was, and I've actually gotten more questions on this than I would have thought, but Sierra Mist is almost a non-meaningful part of Pepsi's portfolio. It was less than 1% of revenue if you look at scanner data. And so I think when you look at the broad strength that we've seen in citrus flavored soda offerings, I think a brand refresh makes sense for Pepsi. Sierra Mist kind of was in the market for a while. It didn't really seem to gain the necessary traction that Pepsi wanted it to. And so for them to come to market with a new product to try to maybe go head to head with a Sprite or with some of these other high growth products that are doing very well makes sense to us. But as of now, it's a negligible, they're going off of a base from Sierra Mist that was almost a negligible part of their portfolio.
Have you tried it yet? The Starry stuff? No.
I have not.
We'll have to do a taste test. Gerald, thanks so much. Gerald Pascarelli, Wedbush Securities, SVP of Equity Research Beverages. Appreciate it.